Good morning, options traders. Welcome back, everyone. Well, while I've talked about these concepts in independent videos in the past, I thought it might be a good idea to kind of roll them into one because I got an email over the weekend. I actually get them all the time, but it was another trader talking about the whole benefit of positive theta and that he's going to make all of this money by selling these out of the money options and collecting positive theta because it's the option sellers that win in the long run. And he said, I need to make, let's say, a certain amount to cover monthly expenses. And I said, well, why are you using this trade for doing out of the money options? And like most traders, he said, well, it's very obvious because they have a very high probability of expiring worthless. We know that time's going to pass. We get this positive theta. And over the long run, we're going to make money. Yeah, we might get hit on a couple of them, but overall, we have the overwhelming odds in our favor. Well, is that really true? Well, it turns out that's not at all true, even though a lot of people will tout that. You hear it a lot on YouTube. But let's go find out why positive theta isn't the secret code to profits. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So, the first and what should be the most obvious reason for being skeptical of this idea of selling out of the money puts and collecting theta as being the road to riches is the very definition of fair value. Always remember that options are, at least theoretically, priced at fair value because a buyer isn't going to intentionally overpay for an option just to contribute to your monthly expenses. A seller isn't going to intentionally sell them at a price too low just so you have a better chance of making money as the buyer. Both traders are trying to do the same thing. And if options appear to be too low, people will start pushing their prices higher, and then that edge is gone. If option prices appear too high, people will become sellers and push those prices lower until that advantage is gone. And that's why we say, at least theoretically, they should be priced at fair value. So fair value is a financial concept that just simply means it's the price at which the buyer and seller break even in the long run. Not necessarily from trade to trade, but if you were able to do hundreds or thousands of trades, not counting commissions, under these identical conditions, that you would expect to break even in the long run. So for example, let's say that the stock is trading for 100, you go to a pricing model and say that the $90 put is worth $2. Or maybe that's the price that you just see in the open market. Well, if you sell that option for 2, before you start thinking, hey, somebody just gave me $2, why did they give you 2? The answer is, once you understand fair value, is that you're expected to lose 2. They're not giving you this free money just to contribute to your monthly expenses. You're collecting $2 up front because that is the mathematical amount that you are expected to lose, because that's the very definition of fair value. Now, on the other hand, let's say that you were the buyer of this $90 put for 2. Why would you spend $2? Well, for the opposite reason. You're expected to gain 2. So notice that if you are collecting 2 as the seller, you're expected to lose 2. Your overall profit is 0. If you pay 2 as the buyer, you're expected to gain 2 so that your overall profit is 0. Now, again, we know that from trade to trade, it rarely works out that perfectly. That's why it's called a long-run concept. But this is very much the reason that people think that getting the $2 up front for selling an out-of-the-money option is just free money. And so always remember the basic concept of fair value. If you are selling an option for, let's say, $2, it is not free money. It's not the amount that you're expected to gain. It's, in fact, the amount you're expected to lose. So that's the first reason for being skeptical of this whole secret code about selling out of the money options and getting positive theta. The second reason is stock price risk. When people talk about positive theta, it's assuming all else stays the same. And we all know that stock prices can move a lot. It's in fact the reason that traders are willing to pay for options. They're willing to expose themselves to this negative theta as the buyer because they're anticipating potentially large stock price movements. So remember, yes, you might have the benefit of positive theta on your side, but you are absolutely accepting a very large stock price risk. So remember, if you are, let's say, selling puts, here's our risk graph. We have our bend at 90. So yes, if you sell this put for 2, that's the most you can ever make. It's a fixed amount. Don't forget that. That's the most you can make, but stock prices can certainly move more than $2. So if the stock is up here at 100 and you're selling the 90 strike down here thinking it's a long ways away, don't forget that you have potentially catastrophic risk. Yes, it might be true that 90 is a pretty good bit away from the current $100 price, but what if it gets there? What's going to happen? Suddenly you are now facing much, much larger losses. Is that really worth the $2? So always remember, yes, positive theta can be your friend if the stock price stays the same, but one of the risks that you are absolutely accepting is stock price risk, and that's a big one. Now, a second risk is gamma risk. So remember that option prices can change dramatically if the stock price changes. That's what we just saw. But gamma is one of our Greeks that measures the change in the delta. It's showing how sensitive your delta is to changes in that stock's price. Is that option's delta going to change just a little bit or quite a lot? So gamma actually measures the stability of the delta. That's another way of looking at it, or the instability, if you want to look at it that way. So if you have an at-the-money option with a very high gamma, it's telling you that those deltas are highly unstable. Now, yes, you might be selling an out-of-the-money option with, let's say, a 20 delta and a fairly low gamma, but that's a fairly low gamma and delta now. Let that stock price move, and suddenly we have a new risk of gamma risk. So let's take a look at this graphically. If we look at under a Black-Scholes pricing model, here is positive theta. This is what the graph looks like. And what this is telling you, let's say for the at-the-money strike, I've got the stock at 100, that your theta would be this much per day. Looks like about 5.5 cents. Now, obviously, this is going to change with time to expiration and volatility and stock prices, but for any given set of parameters, it's going to have the same shape. So notice that as the stock price rises, or if it falls, that the rate of that theta starts to fall. So again, if you're just focused on positive theta and I'm receiving a credit, you have to understand the reason for that is one of the risks is gamma. And what does that risk curve look like? Look at that. You've got negative gamma, and it looks almost the mirror image of your theta curve. That's something that a lot of traders overlook. So yes, you get a certain benefit, but it's counterbalanced by something else with equally likely probability. So what makes you think that positive theta is somehow the road to riches? Let negative gamma enter the picture and you'll see very quickly why people are willing to pay to be long options. So this gamma risk is a second big one for being the options seller and thinking you're getting free money with this positive theta. Third one is Vega Risk. So option prices can change dramatically from changes in the stock's price, but they can also change dramatically from changes in volatility. So yes, you might be getting this positive theta from the stock price sitting still and volatility sitting still. But what if the stock prices move? Or what if volatility moves? Or what if they both move? See, there's a lot of other risks that you're accepting. So let's go back to our $90 put and put the stock up here at 100. So remember, we have a bell curve centered over the current stock price. That's just telling us that at this current volatility, this is the range of stock prices we would expect. So look to the left of 90 right here. It looks like it could maybe dip down to 80, very low probability. 85 is not totally out of the question. But for the way that I've drawn this curve, we have a maybe a 5% chance that it's going to dip below 90. However, what if there's, let's say, an FDA announcement coming up, or an earnings announcement, or an election? There's a lot of things that could move the volatility. Fed announcements can be big ones. And what that does graphically for us is that this curve gets shorter and wider. So take a look at the stock prices. Over here, 80 has a very low chance of getting hit down here. 85 is pretty low. But watch what happens when we increase the volatility. We're keeping the stock price the same, but the curve gets flatter and wider. See, now 80 isn't all that insignificant. 75 isn't either. 70 isn't. 65 actually has a very small chance. See, under the previous curve, 65 to 75 really had no chance of coming into play. But once volatility increases, now we're saying yes, it can. So we don't even need the stock price to move. We just need volatility to change. And that can quickly put you underwater on your naked options. Now, there's another concept related to this volatility, and that is normalized Vega. We've talked about this one before. So normalized Vega is a concept, it's a calculation where you take the options Vega, another Greek, and divide it by the options price. And what this does is it shows the percentage change in an options price for a one tick move in volatility. One tick just meaning 1 percentage point change. So let's say from 20% volatility to 21, or from 20% to 19, or 37% to 38. Those are all one tick moves in volatility. How much is your option expected to change in terms of percentages? That's what normalized Vega shows. So for example, if we go to a pricing model, let's say we have a $100 call that's trading for 232 at 20% volatility. Now that same pricing model shows the Vega of 0.11. So what that's telling us is that if volatility increases from its current 20% level to 21, a one tick change, this option trading for 232 should pick up 11 cents. So that $100 call should go from 232 to 243. So normalized Vega, the calculation said take the Vega of 11 divided by the options price of 232 equals 4.7%. And if we take a look at the percentage change between these two prices, which we can find out by taking 243 divided by 232 equals 1.047, which just shows us it's a 4.7% increase, exactly what is predicted by normalized Vega. So when you are trading out of the money options, it is true that at the money options have the largest Vega. They've got the largest absolute number. But it's the out of the money options that have the largest normalized Vega. And that means they are subjected to the largest percentage changes. And if you think about it, percentages are a bigger risk. So let's take a look at some examples. If you double volatility, if volatility doubles and at the money options price doubles, but your out of the money options go up multiple times more, this is another big risk of going out of the money. And then further, as volatility rises, traders are tempted to sell further out of the money options, thinking they're safer, but it actually makes them riskier. They have got tremendous normalized Vega. So for example, let's go to a pricing model. We'll put the stock at 200, the strike at 200. It's an at the money option. And it tells us that the put is trading for 686. Now let's double volatility. Let's take it from 30% to 60%. So that's a twofold increase in volatility. And as expected, our put option over here, the call as well, should double. So we're going to go from 686 to 1371. So we get a twofold increase in volatility. We get a twofold increase in the option prices if they are at the money. And that's what these are. The stock is 200, the strike is 200. But watch what happens when we go out of the money. We'll keep the stock at 200. We'll put the strike at 180, so we're looking at an out of the money put. So it's trading for about 87 cents. And this is where traders will say, well, it's out of the money. It's not going to get hit. High probability. It's like free money. However, it's only 86 cents. So let me sell it 10 times and get 869 bucks because I need to make my car payment. It looks like free money. But watch what happens if volatility doubles from 30 to 60%. For the at the money option, we saw it would double the price, but watch this. Now it's sixfold. So that option that you collected, or let's say the 10 puts that you sold for 869 bucks, are now a negative 5,385. And you're not even at expiration, and they're still out of the money. Broker could easily shut you down right now without even a phone call. But watch what happens if the stock price falls. Normally, the reason we get a bump in volatility is after the fact, after the stock has dropped. So let's say the stock has dropped from 200 down to 185. All right, so we're going to let the stock price fall 7.5%. Not that we've ever seen a stock fall 7.5% before. Remember, and this doesn't have to be over the course of a day, it could be 2 or 3 days. But the stock takes a hit. Volatility we're still going to keep as doubled from 30 to 60, but now we're just letting the stock price fall. Now look at this. Now your options are going to go from about 87 cents to 7.91. That's a ninefold increase. So again, you collected $869 of what appeared to be free money, but now you're in the hole for $7,912 and counting. So the main thing to understand is that even though you hear a lot of this stuff on YouTube and from other traders that you should sell naked puts to get all kinds of free money, it is simply not true. There's a reason that traders are willing to pay for that insurance. It's because stock prices can move, volatility can move, gamma can change, Vega can change, and you've also got normalized Vega to contend with. And so if you don't understand how those risks occur or why, you have to be really careful about using positive theta strategies as the secret code to riches. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.